Hey, welcome back. Today we're going to be talking about how does a hard money loan work in real estate. So hey, if you're interested in using hard money loans to grow your real estate portfolio, that's what we're discussing in today's video, all the way from how to find hard money lenders, how the application process works, the ins and outs, the pros and cons, and what to look out for. Stay tuned. So first of all, what is a hard money loan in real estate? Well, a hard money loan is typically a short-term, high-interest loan that's made on non-owner occupied properties. It can be a single-family home, can be a commercial property, but typically these are flips or short-term type deals. And a hard money lender is typically a professional real estate, what I call loan shark. I say that tongue-in-cheek because they're not like Vinny from The Sopranos or anything like that. These are professional money lenders, but this is how they make their money. So they tend to charge fees, they tend to charge very high interest rates to make that money available. So how do you qualify for a hard money loan? Well, there's good news and not so good news. Good news is it's way easier to qualify for a hard money loan than a traditional mortgage with a bank. Why is that? Because primarily what the hard money lender is looking at is the property. Whereas on the other hand, if you're trying to get a mortgage with a bank, they're looking at you and your personal ability to repay that loan. The hard money lender, they're looking at the property, how much equity is in the property, how much cushion do they have if you default. So they know that if you don't pay the bill, they can take that property, they can quickly turn around, get it sold, and get all their money back out and maybe a profit on top of that. So again, not so much your own personal credit history, not so much your own income, although they're going to ask that kind of information, but they're not going to be anywhere near as intrusive as the banks. What they really want to see is what is the property, what condition is it in, how much are you paying for it, and what's the real value, current value of that property. That's how they're going to determine how much money they're going to loan you. So where do you find these hard money lenders? Well, good news is they're pretty easy to find, especially if you're in a major center. You can Google it. You can look for hard money lenders, Chicago or wherever it is, whatever area you're in, Toronto, Vancouver, Los Angeles, wherever you live. Google it and some will show up there. Better yet, go to your local real estate investment club or real estate investment association and ask around. Find out who is currently using hard money and who do they work with. Get some referrals, get some recommendations, ask around, see what the pros and cons are, and ideally get 2 or 3 of these hard money lenders ready to go in your back pocket for your next deal. Now let's take a quick look at the application process for getting a hard money loan. Like I said before, you don't have to jump through all the hoops of trying to qualify with a big bank for financing. However, chances are a hard money lender is still going to make you fill out an application. But what they really want to see is they want to see all the details about the property. So the more of that information you can bring to the table and the more complete that information is, the more likely it is you're going to get the loan and the faster it's going to happen. So I highly recommend that you spend a little bit of time putting together a really good package about your deal. Talk about all of the finances. This is where you do want to talk in a lot of detail about the financials of the property. What the hard money lender wants to see is, wants to make sure that the property is going to be free and clear. They want to make sure that it doesn't have any encumbrances on it. Want to make sure they understand exactly how much you're paying for that property and what the current value of that property is. So they're going to want to see appraisals, or they're going to want to send in their own appraiser to do an appraisal of the property. They're going to want to see comps. So the more details that you can provide them, pictures, everything, any information you've got, put it into a package, it's going to increase the likelihood of you getting accepted exponentially. And then once you develop a relationship with 1 or 2 of these hard money lenders, it becomes easier because they know that they can trust you. They know that you're a person of integrity. You know that you're going to pay them back. That's what they're really concerned about. But they always want to see details, detailed details about the deal itself. All right, let's take a little look at the loan terms and the details about the loan. So typically with a hard money lender, you are going to be paying much, much, much higher interest than you would if you got a mortgage or a loan from the bank. Why? Because you're paying for speed. You're paying for the fact that you personally don't have to qualify for the mortgage. You don't have to qualify for the loan. It's all around the property. So what are the interest rates and fees that are involved? Well, it really depends. Each private lender is a little bit different. Some private lenders charge points, what are called points, on the loan itself. So for example, if you're borrowing $100,000 and they charge 3 points on that, that means you're going to have to pay $3,000 just to get the loan going. They may charge that up front, or they may tack that out at the end, but that's part of how they make their money. So that's charging points up front on the loan. Then they're going to be charging interest on that loan. And typically this is a short-term loan, so it's 6 months or 12 months or maybe 18 months, usually not much more than that. And they're going to charge you, let's say, 12% on that. So if it's 3 points and 12%, and it's a $100,000 loan, then you're going to be paying $1,000 a month on that loan. Usually it's interest only. They're not too worried about the principal until you refinance or sell the deal. So different lenders, different criteria. Some people charge the points. Other people just charge a higher interest rate. So instead of charging you points and 12%, they might charge you 16% or 18% and maybe just a few fees. And that might seem more expensive, but if you're in and out of the deal faster, that can actually be a lot cheaper in the long run. If you crunch your numbers, you see how much those points are going to cost you, how much the difference is in the interest rate. It could very well be in your best interest to pay a higher interest rate. So make sure you crunch your numbers and you really understand how long you're going to need the money for. So how do you pay back a hard money loan? Well, you're going to be paying part of it during the actual deal itself. So again, the interest is usually charged on a monthly basis. So again, if you're borrowing $100,000 is 12% interest, pretty simple. $1,000 a month during the term of the loan. And then when you sell the property or you refinance the property, then you pay out the balance. You pay out the initial $100,000 and maybe the points if you got to pay the points there. So you'd be paying them back the $103,000 or whatever that looks like. So that's typically how it works with the payments on a hard money loan. You're paying monthly interest fees and you're paying the lump sum at the end of the term. Now you have to be very, very careful for this because if you default, if you don't make your payments on time, if you're not able to close or finish the deal in the time frame, it could actually make them foreclose on the property, especially if you're a few months behind. So you have to make sure you keep on top of things, you're paying everything out, and if you think you're going to need an extension, don't wait till the last minute. Make sure you let them know ahead of time, and ideally, you've already got that set up in the initial agreement. What happens if I need an extension? Here's exactly what's going to happen. We're going to charge you this much, and the interest rate's going to change to X amount, or however they do that for doing extensions. Make sure you understand that ahead of time. So what do you think so far? Does that sound appealing to you, working with a hard money lender? Well, maybe it does, but there's another option you could look at as well, and that is, instead of a hard money lender, what if you brought on a private money lender or a joint venture partner instead? So what's a private money lender? They are somebody who loans you the money, but they're not in the business of lending money like this. They're not a real estate loan shark. They're a private individual who's looking for a better return on their money backed by something solid and tangible, a real piece of property. So sometimes these people don't even know they're private lenders until you show them the opportunity. So this is a great way to start raising capital for your deals, and instead of paying super high interest rates, you pay something more reasonable that's a win-win. It's a win for you because you're getting cheaper money. It's a win for the lender because they're getting a higher return on their investment backed by something solid compared to stocks, bonds, mutual funds, cryptocurrency, whatever they're doing right now. Or you can also bring on a joint venture partner, and that's somebody who's going to bring the capital, the money, and the credit to the table. You join forces, you bring the deal, you bring the team, and you share in the profits, but you also share in the risks. Great way to lower your exposure because you don't have to be making payments to these people until the deal starts making money. So you can consider those instead of going to a hard money lender. That reminds me of a client of mine, Sean Nelson. Sean is a flipper, and Sean was working with hard money lenders, but he got tired of paying these really, really high interest rates and all these points on his loan. So he started bringing on private investors instead, private lenders instead. And that has really transformed his business. Now he's able to do deals and make them much more profitable because he doesn't have to pay these crazy high fees. He's still able to get access to the capital really, really quickly because he's got these lenders lined up ahead of time. So you can do the same thing. Speaking of which, if you'd like to learn how to do that, if you'd like to learn how to bring on private lenders and joint venture partners, I've got just the ticket. It's my book, The Money Partner Formula. You can get it by clicking on the link in the description below or go to investorattractionbook.com. And this is going to walk you through step by step by step exactly what to do and how to do it to attract investors to you instead of you chasing after them. Grab your copy today.